All right. Hello, everybody. Good morning or good afternoon, good evening, wherever you are. So Ryan and Cayman are still away this week and most of next week, I think. So Steve and myself are going to take you through the day's overnight events and discuss a few things. So let's start with Nancy Pelosi. So she went to Taiwan, made a couple of speeches. The Chinese, in return, from what I read, they announced the most daring military drills in quite a few decades, all around the island of Taiwan. So there's more fighting talk from both sides, and let's hope that this is all it is. It stays to that, and then she goes, and then we're back to normal. But the Pelosi's moves definitely moving the markets a bit, and we wait to see what the next headline is. The other important thing we had news-wise was a couple of Federal Reserve officials, so Mester and Daly. They both said that they both basically talked a hawkish talk, and they kind of tried to push back this notion of the market that we're very close to a turn and to a pivot by the Fed, and rate cuts coming next year. So they're still trying to talk the hawkish talk. And to be fair, they've all been very consistent about it. Jerome Powell has said over and over again, they are looking at inflation. End of story. And inflation, well, it's not really pivoting yet. Pardon the pun. So this caused bonds. So bonds is the first thing I look at. So bond yields in the US did a quite spectacular turnaround, and we've been talking about this 270 break, and we broke that quite substantially. We got to the low 250s, and now we're back above. So if this turns out to be a false breakdown, man, this is going to be a big, should be a big continuation move to the upside. So, false breakdowns lead to breakouts, and false breakouts lead to breakdowns, usually. Not always, but usually. So if this is the case, then we're definitely going to be testing this top side, which comes in around 290 something. There's a fib as well there. But really, if this gathers traction, we go back to the plan that I'd said before, that I think there's one more final push to the upside in yields, and maybe even take out these highs, 350 and above. This would mean that the market would move the rate cuts from 2023 to 2024 and beyond, and it's not unreasonable to envision that. Yes, we are in an economy which is, I'm talking about the US economy now, but it really applies to most Western economies. They are showing signs of weakness, and leading indicators are, excuse me, not doing great. The lagging indicators like employment, they're still okay, but they are lagging, exactly like the word says. So I would put a lot more emphasis on leading indicators, and data matters, as we've said before. Speaking of data, we had a number of releases today. Swiss CPI, something a lot of people were looking at, was expected to go up 0.1 to 3.5% year on year. It actually stayed flat, 3.4 year on year. German trade balance came in a lot better than expected, 6.4 billion versus almost flat. But we need to remind ourselves that, for example, over the past 5 or 10 years, the average was something like 15, so 3 times this number. So it's the German trade balance is still a lot lower than it used to be. We also had PMIs, services PMIs from quite a few European countries, and overall it was good, with the exception of Italy, which went into contraction. Overall, it was good numbers, and so we had German PMI better than expected. The European Eurozone overall 51.2 versus 50.6. We also had PPI out of the Eurozone, which is still printing in the mid 30%, 35.8% year on year. It's ridiculous, but that's the reality we live in. And we also had UK PMIs, which missed. So it kind of a mixed bag because we also got Eurozone retail sales quite a bit worse than expected. So it's a mixed bag in terms of numbers, but they do matter. And we do have ISM non-manufacturing PMI out of the US today, which is the important number of the day. And obviously we have payrolls on Friday. But as I said before, the lagging indicators are still looking okay, but I wouldn't be surprised if they start turning. And, I was reading an article about energy prices in Europe being so much higher than they used to be, and manufacturing is just suffering. You can't, they just can't make ends meet unless they raise prices dramatically. So they're cutting workforce. They're doing everything they can to streamline and, make the companies leaner. So that's going to eventually translate into higher unemployment, unfortunately. So these indicators are going to change. I think they're going to turn.
So it's not the greedy corporations that are scamming the public and skinning the public.
Yeah, like some politicians were just saying, we're going to put a price cap to.
It's really funny, Stelio. They're recycling all the failed rhetoric from the 70s, just because a lot of people don't even know it, because many of the people
they weren't born then.
Or if they were born, they were very, very young. You know how it is, because the population is in general uneducated. The rhetoric is the exact same one, and it's so ridiculous and so easy to debunk, even if you're not an economist, right? Corporations have always been greedy, right? The driving force of capitalism is greed, right? But if the corporations are the problem because they're greedy and they're trying to skin the consumer, how coincidental is it that they remember to be greedy during a period of inflation? Inflation is not created because of corporations. Actually, I was explaining yesterday on this, or was it the Morning Edge? Probably it was the Morning Edge. How corporations actually, which is more or less what you started explaining, how corporations actually are less profitable normally under
absolutely
an inflationary environment. That's the joke of it, right? I mean,
yes. And you have politicians, you have country leaders saying we're going to put a cap on energy prices, or petroleum companies, how much they sell their oil, and they say you can't do that. It's not their choice that oil is at $100 rather than $50. It's not.
And if you know what the fun part is, that no politician was worried about it when the price of crude was like $10, $15, $20, and companies were closing one after the other, right? Then they weren't greedy, as it seems. They were just stupid. You know what I mean? Because so stupid of them. They could have been selling oil for $100, but they were stupid enough to try to sell it for $20, which is below their extraction cost, right?
And governments also conveniently forget that a huge amount of the price people pay is taxes, right? on the pumps or whatever. So anyway,
a huge amount. Actually, there are some countries like ours, but we're not the exception in this. That the fuel, for example, are double and triple taxed.
Yes,
and some of the taxes are not even on price. They are on the quantity of fuel, and that's why, for example, if you remember, prices of gas were still very elevated, even when crude was short-term trading into negative territory, right? Because so much of it is taxes.
Yeah. Anyway, bottom line, I was talking about yields. I was talking about the 10-year, which this could have been a spectacular false breakdown from those previous lows. If that happens, then I think we're going to be heading towards the upside of this.
Same exact picture in the USD yen, obviously, for obvious reasons, right? Actually, USD yen was, and I talked specifically about it when we were doing the flow show yesterday, it was trading below the key 131.50 level. But as always, I said, let's give it a little bit more time. Let's see how we close the day.
Yeah,
And look at the big reversal we had from the intraday lows.
Yeah, absolutely amazing. Yeah, so otherwise, stocks are still recovering. You know, they had off this Pelosi visit today, there was a little bit of a wobble, but really they're still trading quite well. And I wouldn't be surprised if we get another little push in the S&P, maybe towards 4,200 or something like that. But it's still, you know.
To be honest, it looks resilient, right?
Yes.
I mean, it's practically consolidating the prior gains, and obviously, you know, I don't know who would have bet on that, but I don't know who really believed that the beginning of the end of the world would would be yesterday with Pelosi flying to Taiwan. But
if you think about it, though, stocks are still trading, I think, very well given the general macro picture. You know, we still have high inflation, we still have yields. Okay, yes, we dropped a little bit in 10-year US. In general, we dropped in yields, but we still, I think the risk is for yields to go higher. And in that scenario, the stocks are still trading well. And I guess the market is already looking forward to the coming rate cuts and the coming QE and the coming, more of the same that we've seen since 2008. Maybe it's getting ahead of itself. You know, I spoke to a friend of mine who's not a trader, but he's very knowledgeable. And he said, look, I want to make an investment, with a 20-year horizon. I'm just buying stocks here on this dip, the end. And I'm like, yeah, okay, you could see the S&P go towards 3,400, but if you're buying with a 10 or 20-year horizon, you're probably going to be okay, simply because of inflation and because of inflation.
Yes, exactly.
It doesn't make sense, but it's no, it does make sense, but it's unavoidable. When
it is unavoidable, exactly as you go back in time and look in the magazine, for example, the prices of cars many decades ago, or the prices of houses. And imagine, specifically having to do with the prices of cars, imagine, Stelio, that with all the progress, the technological progress we've had since then, if prices had remained the same, right, if there was no inflation whatsoever and prices had, the price level and the deflator had remained constant, zero, they would have definitely ended up being a lot cheaper than they used to be, because that's what happens with anything that has to do with technology, right? We build the technology, we improve it, we mass produce it, and all that makes something cheaper, better in quality and cheaper in price, right?
Yes, absolutely. Anyway, I think this is the case and it will continue. The only case where I'm going to reconsider this really long-term thesis is when I see major economies starting to turn out surpluses and, letting debt mature. And what is Arif saying?
Arif is saying, by the way, they cannot tax me cycling yet. Sure, they will in the future. Yes, they absolutely will. This reminds me, Arif, I don't know if you're familiar with the US gift tax and the state tax. I think these are the names. You know that, Stelio, right? That you are, and that applies unfortunately to many countries. But there is a unique there's a unique property here, because the Constitution allows for very specific taxes. So what happens is that gift tax, state tax are unconstitutional, right? So to make that legal, if I'm not mistaken, you're not being taxed to pass on your property or to gift something. You're being taxed for the privilege of being able to do that.
Oh,
I don't understand. I don't know if you understand the difference.
Yeah, okay.
Yeah, so otherwise it wouldn't be legal. So one day they might come up with a tax that it's you're going to be taxed for the privilege of using your bicycle, not for biking, just for the privilege of using your bicycle, right?
Or for the privilege of breathing. Okay.
Or for the privilege of breathing. Yeah.
So What else? Metals there, yeah, trying to bounce today. Gold has been.
Yeah, big reversal in metals yesterday as well, right?
Yeah. Gold less so. Gold
Gold
was a
new
lot.
high. Gold new high on the day. It was looking very well bid and ended up closing below the open of the previous day, right?
Yeah.
So quite a big reversal there in gold.
Which is understandable as yields were rising, so it's the knee-jerk reaction.
Yes,
silver did worse. Yep.
Silver, on the other hand, did not have this type of reversal. It didn't print a new high before reversing lower, but on the other hand, from a candlestick perspective, it printed an evening star formation.
Yeah.
Right. So I'm not surprised. I think pullbacks, short-term pullbacks might be beginning as we speak. But I do think that for both gold and silver, even if this is a corrective rebound, I was saying that yesterday again, I think there is more to it. So I think that pullbacks will probably find buyers. Pullbacks in silver specifically towards 1940, in my opinion.
Exactly. I was going to say, if you remember, Monday I sold a quarter of my position at 2040, and I have my order 1940 to buy it back. So
no, I didn't remember, but that's a good level still. And in the case of gold, I would say 1740 to 1745 is probably the area I would expect again buyers to step in.
Okay. I'm going to stop sharing if you want to take over and show a couple of things.
Absolutely. I heard, because I came just 5 minutes late, I heard that you already went over the data that we had earlier today. They actually, a vast majority of them were PMIs, right?
Yes. Talked about a little bit about Pelosi.
By the way, I don't know if you saw it outside the PMIs. Very big bit in German trade balance.
Yes, I talked about that, but if you look at absolutely. But if you look at the past, say, 5 years, the average is 3 times that. So it was a big. It's seen a very big dip, but yes, very big beat on.
I know, but they still expected it to be flat.
Yes,
right, and it came in at 6.5 billion.
Yeah, we did talk about that. And that was driven, if you look at the imports and the exports numbers, it was driven by exports, basically. Big increase there. Anyway,
something for people actually to consider, right? The vast majority of these type of prints are not inflation adjusted, right? As retail sales that I've talked before. So, for example, what I'm trying to say here is that keep in mind that trade balance, for example, we take the prices, I'm 99% sure about that, we take the prices as is, we don't adjust them for inflation. So keep that in mind in general. Which means basically what I'm trying to say here is that an economy, for example, that is mostly exporting is going to be, the headline number is going to be, pushed higher by inflation, right? Because if you're exporting more and inflation, of course, affects both imports and exports, but if you are exporting more, that means that the price of exports is going to go up. Of course, as the price of items goes up, demand, it's a demand supply thing, goes down, right? So on the other hand, many times you'll see that, for example, the dollar amount or the euro amount, doesn't really matter, of what you export might have stayed flat or might have gone up. But at the same time, you sold a lot less items, right? Because prices go up. So that helps with the trade balance numbers stay elevated, right? The export amount, etc. But at the same time, you might have sold less items at the same price, right? Or you might have imported less items at the same price because prices are going up. So keep that in mind. Okay, so having to do with yesterday we had quite an extensive session, so we're not going to have such an extensive session today, simply because we've had some movements in the market, and I'm going to go over them, but some other things didn't really substantially move. In my opinion, the the focus here, and I went over all the yen pairs because of the importance of USD yen and where it was trading yesterday. The most important chart today is this one, USD yen, and how it not only saved itself from breaking down from 130 to 150, which would have been a big bearish development as we were talking about yesterday, but actually closed by erasing all the losses of the prior day, right? So quite a big reversal here, which, as Stelios said, came on the back of this big reversal in yields, right? So yields yesterday practically erased more or less 1 week of losses, right? We're back in the level we were at 22nd of July, right? So quite a big update yesterday in yields. If you remember, I've kept showing this descending channel here in yields. I've said that as long as this descending channel is holding and we don't accelerate below it, there is a very good chance that we're going to see new highs in yields. Of course, one up day doesn't make this a victory lap because there is still the chance that we will continue lower. But what I'm tracking for the moment is this descending channel. And as long as the pullback remains orderly, technically speaking, I will still expect that eventually we're going to have another leg to the upside, right? For the time being, the decline remains orderly. I know that we've pulled back more than many people expected, but that doesn't necessarily mean much. And here is the 30-year US yields, quite an equivalent picture. Only difference here being we are closer to a bullish breakout. 30-year yields are holding even better than 10-year yields. So that's it. Notice that the yield curve oscillates, but in general remains rather flat, right? We just have 25 basis points of a difference between 10 and 30 years. So take that as you want. We've had several instances during the past few months that big part of the yield curve was inverted and still remains. In general, the yield curve is not sending positive messages. That's the only certainty. Now, of course, on the back of all that, we had a big recovery in the DXY as well, which printed a very, very big outside white candle also, holding this 50% FIB and 50 DMA at 105.30. So basically, right, basically somebody can be, long the DXY, long the USD yen, long the 10-year yields against yesterday's lows. From a risk-reward perspective, it's a viable trade, right? From a risk reward perspective, you have a very well defined reversal, and the risk is still very tolerable, and there is a potential upside. Now, I'm still skeptical. I think that the markets are more or less choppy at the moment. Yes, big reversals and all, but I think the markets, have the potential of going either way at the moment. And the biggest, in my opinion, the biggest driving force here is going to be data, right? Because some of the central banks have already started pivoting, having to do with rhetoric, meaning stressing out that yes, we've done some fast hikes, but now we're going to be more data dependent. So the market is now trying, it's like oscillating and trying to decide on what kind of short-term future it wants to price in. It's not an easy task, admittedly, right? It's not an easy task at all. I think we are going to remain in a state of flux with moves in both directions until we see a more clear either continuation of what they've been previously doing or pivot. Keep in mind that central bankers don't make it any easier. Stelio, I don't know if you're still here. Who was it that came out yesterday? Which of the Fed governors was it that came out yesterday?
Messer and Daly.
Yeah.
They were both out, yeah.
And in essence, they were sending hawkish messages again,
Yes,
right?
yes.
Yeah, so market gets very confused with things like that, right? Because on one hand, they get a hint that, we might start slowing down, and then you have some Fed governors coming out and saying we see absolutely no evidence that inflation is slowing down, etc., which of course is sending the opposite message that we're nowhere near the end of this cycle. Of course, the problem is that these people confuse the markets. At the same time, we know how double mouthed they can be, right? We're talking about the same people that literally very few months before they admitted that inflation is completely out of control, they were claiming that inflation is transitory. So I wouldn't be surprised if the same people that are sending hawkish messages literally 2 or 3 months later are advocating for rate cuts. That's the problem with them, right? That they're completely untrustworthy, having to do with their attitude and their way of doing business and conducting monetary policy. In any case, big reversals, short term in gold and silver, and the same thing applies what I said before, meaning from a risk reward perspective, you can be short against the highs that we printed in one case yesterday, because in the case of gold, we had a new high yesterday. In the case of silver, we had a new high the day before yesterday. We more or less matched it yesterday. Right. Now, I already said in gold that I would be a big believer of having seen the bottom when we finally broke through the channel. Obviously, for the time being, we're getting rejected before even testing the channel. So in the case of silver, we got rejected by back testing this previous broken channel. So in both cases, we might see more downside, at least in the very short term, and we see how it goes from there. Now, what did not reverse yesterday, though, was Aussie, for example, right? It is making a little bit of an effort to pare back some of its losses today, but in general, the big downside candle did remain yesterday. It makes sense, right? I mean, it makes sense because we also had the China tensions, right? And you know how sensitive the Aussie can be to that. So Aussie didn't really see any respite intraday yesterday, despite um, uh, you know, other things moving from where they were at the beginning of the day. And it makes sense, right? Because the dollar strengthened, we had the tensions, as I said. So in the case of the Aussie, against 70.50, somebody can be looking for perhaps for a little bit of a deeper pullback. And if we are to continue higher, I would assume that we will find support anywhere between 68.50 and 68.30, 68.50, somewhere there. So I would be looking for support there. In the case of the Kiwi, let me pull it up. Here it is. In the case of the Kiwi, rejected from that green trend line, we were monitoring the 50 fib, etc. Watch for 61.60, 61.70. And now, having to do with stocks, what I was saying before is, we've had a little bit of a pullback, etc. But if you look at the S&P, for example, this looks more like a little bull flag forming than anything else, right? We've broken through this channel and we seem to be riding the channel's trend line resistance as support for the time being. So with all said and done yesterday and all the, nuclear, third world war headlines, etc., the pullback in the S&P was more or less a minor blip, right? And you do understand that as Pelosi's visit is ending and coming back and all that, and nothing really having been started, no World War III, etc. The the indices and investors are going to completely forget all these short-term headlines and just keep on doing what they intended to do. And we knew that the indices were on a path higher for some weeks now. 4100, as we've said, big level, currently holding as support, right? So if we do hold above it support, it's more likely that we're going to see more upside here in risk assets than anything else. Let me see if we have any questions. Stelio, why is there no ADP release this week? I think they've, if I remember right, they've paused it for a couple of months. Am I right on that, Stelio?
I don't know is the answer.
I know that, I don't remember the exact reason, but they had pre-announced that they would be pausing it, but I never went into details of why they would be doing that. And I don't even remember the exact period of time they said they would do it. But I never paid close attention to it because it is what it is, right? It's nothing major, but they have pre-announced that they would do it for a period of time. I think a couple of months or so.
Okay.
Yeah, because they're changing the way it's calculated. Yeah, for a couple of months. Yeah, it was. Catherine says that. So I'm right about the duration. A couple of months. They're adjusting the way they're probably thinking. Whenever you hear the government adjusting the way something is calculated, you can expect it to come back a lot less reliable than the previous series. Yeah. What's my perspective on ISM today? We've talked about it during the past few days. Employment is a lagging indicator for sure. It might remain looking okay on paper yet for a period of time, but I do expect that any employment, unemployment data are going to start souring once we enter the fall within the next 2-3 months. So I would expect that we will see a worsening in numbers, and it can happen at any given point, right? But it might not happen yet. Now, more than that, I can't tell you because I don't like to go. I'm not in the line of business of doing these type of predictions, right? It's if we take every print on its own, it's a little bit like a lottery number, right? And that's not what I would be doing. But in general, I expect numbers to worsen, if not immediately, rather soon after, as I said, within the next 2-3 months. Okay,
cool. Excellent.
So don't forget, even those of you that are not ForexAnalytix members, don't forget that we do have the F.A.C.E webinar, which is also a free to watch webinar, starting in a couple of hours from now. You can register for that for free if you're not already registered. And I hope we'll see you there.
Thank you, Steve. Thanks, everybody.
Thanks, Tel. Thanks, everybody.